Right now, I want to welcome up my guests, Vivek Shah, Jim Bankoff, and Richard Sarnoff. Come on up, guys. So, it turns out we wanted to have a session about buyers of digital media, but it was hard to find them in 2018. I suppose we could have had Penske, we could have had Axel Springer. I'm running out of names, but it's truly interesting that the three of you have continued to make investments and acquisitions in digital media, which some in 2018 could describe as contrarian in nature. Oh, sorry, I'm supposed to advance that, aren't I? I want to sort of delve into your thesis on that, but just to sort of give the audience a little bit of an idea of what's going on here. Vivek, since J2 Global bought Ziff Davis back in 2012.
That's right.
A deal we worked on together. You have followed that up with a number of transactions. In fact, I think I saw the full list and it was daunting.
Yeah.
How many would you say in total?
Well, I think across all of the company, over 100.
Over 100 acquisitions. So you're probably leading the hit parade in terms of number, but names that we're familiar with like IGN, Tech Bargains, Offers.com, Mashable, and a big one, Everyday Health. So one could probably describe these as vertical, starting with a sort of a tech or a male-oriented audience, but now obviously branching into other verticals. Richard at KKR has invested in a number of content companies, but just to sort of give you some names that you'll recognize, Pandora, FanDuel in the fantasy sports arena, and their big content play, Internet Brands, over $1 billion, which in turn made a number of acquisitions, the most recent and scaled of which was WebMD. Jim at Vox, private company, has bought Recode, Curbed, and a number of other smaller content plays.
Yep.
Eater.
Yep.
All sort of vertical plays. So what's interesting is you all come at this from a different platform. Vivek, you are CEO of a public company, J2 Global. You got a private equity firm and then a private growth company. Tell me a little bit about, again, this notion of being a contrarian in an age where, and the context here is this morning we talked a lot about, you know, and a breakout panel, the sort of mistakes that some of these publishers made, going for scale, over-reliance on large platforms, and running into trouble around their valuations, big valuations over the course of sort of, 5 to 10 years ago, and now come down. I want to hear from each of you sort of in this context, what is your investment thesis that has you still being a buyer of content businesses?
Well, I guess I'll start. So I think at a high level, we like to own audiences. We like to own our inventory. And so I know a lot of the industry is renting inventory or renting data to deliver advertising. Our view is that it's better to own than to rent. And I think some of the things that are happening in the programmatic and trading world, starting with fraud and bots, but now with the GDPR, have, I think, called into question some of that activity. And so I actually think what maybe some months ago was viewed as contrarian now may be in favor, which is contextually targeted advertising, being in quality environments, et cetera. The other thing I'll just point out is that, at least with respect to our strategy from a content point of view, it is cherry-picked. So we're not in every content category. We have, we very much focused on high-value verticals, where the content we're producing helps inform a wallet-based, a purchase-oriented decision. And the reason for that is, yes, we can monetize through the placement of advertising adjacent to that content, but that's really less than half of the equation for us. The majority of the revenues that we're generating from our brands are affiliate commerce, lead gen, performance marketing, subscriptions, and we can talk about that separately. So being able to extract multiple rents from our content and audience is a key factor for us. So when we're in tech, or we're in healthcare, or we're in shopping, or we're in gaming, those verticals match what I described. There are other verticals like general news, entertainment, that we would likely stay away from because they don't have those monetization characteristics.
If we're going in order,
Sure.
So at KKR, and I'll keep it with the private equity frame, we also have a growth equity business, and you mentioned FanDuel was from that vehicle. But from a private equity frame where we were looking at somewhat larger transactions, we need to look at businesses that our average hold period is about 7 years, that will survive the onslaught of all the things you are hearing about today. Whether those are from a regulatory frame or maybe what you weren't hearing about, we're not done with business cycles. And I was just reading today, for example, they asked some Bank of America survey of all financial managers that they got a hold of, what percentage of financial managers feel that the global economy will be stronger a year from now versus now? And the answer was 1%.
Oh.
So we're not done with business cycles, and there are a lot of people out there who feel that there's another cycle that is about to be upon us. So we need to own businesses that can basically power through those cycles, and they need to have enough elements to them of, we hope, growth characteristics that really are either acyclical or anti-cyclical. And when you mentioned WebMD, we feel that market, the healthcare market in general, and particularly the consumer healthcare information market and the professional healthcare information market, have divorced themselves from the economic cycle in a meaningful way, both because of how pharma schedules its advertising and marketing and its drug development, and because of how the population is aging and any number of other things. So we were able to look through whether it was the regulatory issues or kind of macro cycles and say, yeah, we can underwrite growth in that business and underwrite a real value increase over time. And so that's how the private equity frame works. And I would say if you look at what's happening right now with valuations compressing in a number of different arenas, some of them represented in this room, it just makes it easier, but it doesn't make it possible. What makes it possible from a private equity frame is to have a business that you can finance, that you can create a balance sheet for, that has some leverage in it, because that's our model. We are happy to pay very high multiples for things, but we need to have cognizable cash flow that comes from these businesses. And one of the great things about being in a relatively more mature digital media ecosystem is you have businesses that are generating cash flow now. And so those are ones that we can look at and get excited about and potentially transact on.
We're long on content for sure. We're I think the largest independent company by audience size in the U.S. That was created in the last 10 years. And we go after big consumer verticals, news with Vox, SB Nation, sports, tech with The Verge and Recode, food with Eater, et cetera. We have built a big audience that we're monetizing well, mainly off of web audience. But in addition to that, we find leverage in everything that we've built to create new business lines. And so, for instance, last night we were at a screening of a new Netflix show that was built off of our Vox brand. And we're doing the same thing with our Eater brand on PBS Network and our Rack brand on CNN. And so we're able to leverage the IP into new programming businesses. We're able to leverage the technology into new SaaS businesses. We operate the largest, and I think one of the most sophisticated publishing and monetization platforms that we're now able to leverage into a SaaS business model and partner with companies to take advantage of that. We just announced a partnership with Funny or Die, for instance, where they're going to benefit with big cost savings on their end and also a best-in-class technology platform. But all that technology investment to make ourselves more competitive and more innovative in the publishing space is now having these ancillary business benefits. And then a third example relevant to this room in particular is around advertising technology. We knew from the beginning that premium content can't be monetized with janky, crappy ads. So we went about like building a really premium experience in terms of the performance loading of the ads on mobile in particular, doing it with video and shoppable ads that look really great on the page. We built that up for ourselves. We were able to command premium pricing for those. And now that technology stack that we built, we're partnering with companies ranging from NBC to Penske to Flipboard. We just announced a CEO version or C-suite version of this premium digital ad network. It's called Concert with Quartz to go after the C-suite as well. So 3 examples of whether it's leveraging our IP, leveraging our platform, leveraging our ad stack, that we think the more scale, the more kind of intelligent consolidation you can go after, the more leverage you can get in the business.
And presumably, Vivek, you're applying the same type of cost synergies across brand property or titles? Is there a commonality of data infrastructure?
There are some pieces. There's common technology pieces, but we're highly decentralized. So we have general managers who run each of their P&Ls.
Yep.
We have dedicated sales teams, dedicated content and product people. So we think of ourselves, I manage a portfolio is really what it is. It's a $4.5 billion portfolio, but it's a portfolio.
Right.
And so in that way, you've got a lot of dedicated resources. At the same time, there are common technology layers. So there are common CMS and common affiliate commerce technology. We have a data management platform that we built a long time ago that underlies all of that. So tech is common, but people are dedicated.
All 3 of you have sort of, feels like your investments and acquisitions have been focused on verticals, specific vertical in content, and yet there have been horizontal plays across news, Vice, BuzzFeed, 2 examples that have garnered high-flying valuations. What gave you the perspective that vertically, that up and down was better than sideways?
I'll go first. Like we're very much that. I think that's our strategy really, and the reason we liked up and down versus sideways is we believe in scale. We want to be an industry-defining company. We want to go after, I think many of our brands are already leaders for this next generation of digital audiences. But when you scale horizontally, you wind up often diluting your brand proposition, you dilute your advertiser proposition. Let's pick on a portal. I don't know. I pointed out in the case, and I love Lydia, who's running the Huffington Post now. But like in the past, like the Huffington Post would scale by adding a new section every single month, right? And like based on we hired some new people. It's hard to command authority and relevance and ultimately premium pricing and premium audience if you don't mean anything specifically to your audience. Having a verticalized strategy enables you to scale, but it enables you to scale deep. And so I always use the example, like if you want to pick a restaurant in New York, like I go to a restaurant with you, really enjoy this restaurant. Jim, where'd you hear about it? I heard about it on Eater New York. It means one thing to you, like on Eater. If I say I heard about it on portal XYZ /dining /New York it might be the exact same content. It's not, ours is better, but it has a different brand significance that enables you to kind of scale in a premium way.
Yeah, I think the other thing with verticals versus horizontals, they're just simply more projectable. If you have a vertical business that already has any scale and any audience engagement and some real depth with an audience, it's a lot more comfortable to project how that business is going to do than a horizontal audience that may, based on just where the content is going at that moment, kind of flow in and out. I think there's, from a PE standpoint, the projectability of businesses is one of the most important features of our making a judgment to invest in or to buy a business. And we just have a little bit more comfort with the vertical strategies than horizontal, for those reasons. What I think is also useful to understand about about vertical businesses is that what digital brings in general is the ability to scale fast. You know, in previous media history, it took a really long time to aggregate an audience and to make sure that audience stuck, and then to ultimately monetize it. With digital, you can do all of that really fast. But we've also seen with some of these same high-flying valuations, you can lose those audiences as fast as you gain them. With vertical brands, they're stickier. You don't lose them so fast.
Right.
And you know, again, that adds to projectability, but it really adds to investor comfort. So you know, we've been pretty active at Internet Brands, as you know, in the legal field with Avo. Recently, we made that acquisition. We just go deep in a few fields: medical, legal, auto was the other one, and get comfortable that we can really monetize those audiences and have a continuous path of growth of that monetization that really doesn't kick in and out with the vicissitudes of a business.
At a time like this, when you're in a world of declining valuations and some of these companies are in trouble, there's obviously room for opportunistic pickups. Vivek, you recently bought Mashable in what essentially seemed like a fire sale, a fraction of its last financing round. How do you prevent the catch-a-falling knife syndrome in an era of declining valuations? What's your sort of measure of discipline to apply?
Look, I don't think it was a falling knife. I think fundamentally it was a sound business, great brand, great vertical. It had raised money at a very, very high valuation and started doing unnatural things to meet the expectations of that valuation. That's what happened. And so we can come in and say, you're in a portfolio, let's go back to what you were doing that really worked. Stop getting into all of these sort of tertiary areas that aren't value creating. Let's not spend $1 to make $1, to what Rich is talking about. We're very cash flow oriented. And so let's make really good business decisions, not to try to feed some sort of growth rate that your venture investors think you need to generate. So I think there are a lot of businesses like that, that are smaller, subscale, that raised at a high valuation and are doing things to try to meet the expectations of that valuation, and then are finding themselves somewhat upside down. It doesn't mean it's not a good business. It just means there were a series of choices connected to a financing event that I think changed some of the strategy of the company.
Yeah, I think on this panel, our best friend is investor fatigue.
Right.
And you know, we've been through enough cycles of, you know, up rounds and sort of, okay, let's just bring in some more capital from the existing investors, and then, you know, after a while the board faces each other and it's like, hey, we're just done, let's just do something. And that's kind of an opportunity for the people in you know, not just us, for a number of the people in this room, but it is something of a 2018 phenomenon that we're certainly seeing out in the market today.
What role does, I mean, you guys are obviously, you're selling, your businesses are largely advertising or advertising centric, although as you mentioned, Vivek, you've got a number of other diversified revenue streams, largely paying from people who are looking for customers though, so it's in the same vein. How important is the data ecosystem that you build in order to enhance monetization or revenue diversification?
I just think it's a business model question. I think if all you're doing is sort of CPM-based display, video, advertising, that's hard.
Yep.
That is hard to make profitable. I think you have to develop, whether it's lead gen, whether it's transactions, whether it's marketplace, whether it's subscriptions, you need those elements. It is the difference. In the history of media, a lot of models have been dual revenue stream models, right? You look at cable network businesses, if you did not have carriage fees, the advertising wouldn't have gotten you there and vice versa. So it's not new. It just becomes very acute, I think.
Do any of you guys have a paywall? I'm trying to think.
Paywall?
No.
Is there no, so there's no, but there are subscribers.
But we have subscribers not to the content that's free.
Right.
We have subscribers to services. We own a business called Humble Bundle, which is a subscription service for gamers that I leverage my IGN audience to market against, so I can do it on a very sort of cost-effective, cost per acquired customer basis. So you have to be, I think, thoughtful about it. I don't think you can necessarily throw up a paywall for some stuff that was free. I think that's harder to do. I think there are only a few brands that could do that. And
Jim, do you foresee any of the Vox properties being
you know,
paid?
I agree with Vivek. Like, we can't just like wish it so and like put up a paywall and expect people to pay. In our portfolio, we have some kind of what I'll call ultra premium brands. Like Recode is an example where I see a few people in the audience who are going to be joining us at our Code conference. Hey, Bernie, and you know that's commands several $1,000s. It's a community of people who want to pay for a valuable premium experience. It happens to be in real life, and there's some like networking and programming benefits that come along with that. And I think there's opportunities to continue to build off of that. That's an audience that is willing to and able to pay for value. And if we can continue to deliver value, we can command some premium products for that. So short answer, yes, but not like in a traditional like metered paywall kind of sense. I think other kinds of models to get people to pay for value delivered.
Yeah, I think anyone in the media business here should see, at least aspirationally, be looking for a place where they can charge the consumer for their content in addition to, or perhaps in substitution for advertising, because that means your content is just that good. If we look at one of our other investments, the UFC, for example, which is the largest pay-per-view company in the world now, this is highly electrifying entertainment that people are willing to pay $60 or $70 for an evening's entertainment. It's not a paywall, but it's certainly a pay gate.
Sure.
And so, whether you're looking at vertical niches and you get higher and higher key content that appeal maybe to a narrower and narrower audience and maybe closer and closer to their livelihood or their health or something other super important to them that they're willing to pay for, that's when this model gets more and more interesting. And I think there's, we've seen this in the history of media. The moment you have content that's really awesome, the moment you have your Game of Thrones, is the moment you are writing new business rules for your business and able to really monetize in a different way. And for all of these businesses, and I can see many of them out there, it should be at least aspirational for you to get to that place.
Right. And as folks that all have portfolios in the billions or billion to billions, some of which are traded mark to market every single day. Are you buyers of content going
Absolutely.
forward?
Yeah.
You have to. You have assets under management. So
yes, we have to put capital out there. So we're certainly buyers of digital media, digital content, and some of the surrounding businesses that enable that. But I will say, there's been a lot of talk today about data, much more talk about data than media today, in fact. And I don't want to lose sight in this room that we are all media businesses. This content has to be good. Right. We can sell an audience till the cows come home, and we've seen what happens with that. It's a little bit of a lowest common denominator situation. Let's just make sure the media works. Then we'll figure out everything else out.
You would have to rebrand this the Digital Data Summit.
Yeah, there we go. Well, and then you're a buyer, right? If it's really good. Yeah.
So yeah.
Jim,
yeah,
you still buying?
Yeah, we are. We're not like we don't need to do. We're not like a roll-up company in the sense like we're not looking to do M&A as our growth strategy. We still have a lot of organic growth, thankfully, and that's our first concern. But we've always acted opportunistically when we see a quality property that kind of aligns with us culturally, business-wise, et cetera. So we're gonna. I'm optimistic too that it's going to become a little bit more of a buyer's market in that regard.
Awesome. Vivek, Richard, Jim, thank you very much.
Thank you.